We'll talk about New GL today. New GL has been there for many years. This is the classic general ledger in SAP R3. In SAP R3 there are multiple ledgers. There is your classic GL, which is like basic debits and balances for all the general ledgers. And there's a cost of goods sold ledger, and there's a profit center ledger, and there is a special purpose ledger. Special purpose ledger is custom defined ledger, where they create multi-dimensional special ledgers where data from multiple systems go into special ledger for reporting purposes. There's also other ledgers called funds management ledgers and grant ledgers and things like that. So what New GL does is it consolidates all these ledgers into one common single unified ledger. Meets all the legal requirements based mostly the GAAP versus IFRS. Here in the special ledger, people create separate accounts for GAAP and separate accounts for IFRS, and they try to report based on different legal requirements. So New GL supports both GAAP and IFRS reporting requirements. It also supports both the management as well as the segment reporting. It is extendable by company, by customer, and it provides basically a fast close, and also the international accounting standards, and improves the overall compliance and transparency. The main thing that New GL gives you is balance sheet below company code level. In the old GL, you can only get the balance sheet at the company code level. New GL gives you balance sheet at the segment level. That's a major selling point for New GL. Okay? And also the real-time view of your AP and AR balances. And also all these ledgers will go away and you have a single unified ledger. They did that by extending your BSEG, BKPF and BSEG tables. A lot of companies still are migrating to New GL. Some are in the process, but hopefully it's a great skill to have. Same thing here, unified approach. Your PCA ledger is going to go away in the New GL. Special purpose ledger is going to go away. Your reconciliation ledger, CO to FI reconciliation ledger is going to go away in the New GL. Calc, there is a transaction called calc that you run to make sure your total sum of your expenses from your FI equals to your total sum of your expenses on your CO side. So that reconciliation ledger is going to go away. Okay, so you're going to have the traditional GL ledger, you're going to have the COPA ledger, and basically all the documents will be split in real time, and we'll talk about what is a document split. You need to understand basically New GL is a document split concept, and also creating the balance sheet below the company code level or the segment level. And then profit centers are automatically determined, and there's a lot of derivation logic and also zero balance concept. Look at all those concepts. In the traditional ledger, you have organization units as company code, segment, profit center, partner company, partner segment, partner profit center, cost center, and all those things, right? Mm-hmm. Despite its flexibility, general ledger is not a substitute for profitability analysis. Profitability analysis is still needs to be done outside. So New GL, does not do profitability analysis, but it does everything else. What are some of the benefits of the New GL? Management reporting. So additional reporting capabilities have been added. You can drill down to basically at the COPA capability in real time. You can update your BI, virtual cubes, and also your BEX reporting. Extendability. Customers can add some extended reporting tables, reporting dimensions for the BKPF and other tables. Parallel accounting is basically your GAAP and IFRS multi-ledger approach. It has a ledger, leading ledger, and also multiple ledgers. So every time you post, it posts the leading ledger, and you can also set some parameters where it has a posting to non-leading ledgers. It has a, and it also does the fast closing. So ERP eliminates many of the traditional closing steps, such as the reconciliation of the CO ledger. CO ledger is gone. It's completely automatically reconciled between FI and CO. So it kind of eliminates some key steps behind the scenes. I'm going to skip all these things. Skip. Okay, so new GL structure. The original structure started with the company code. The new GL starts with the ledger. So L0, L1, so it is at the higher level, and then you will have the company code, and then account, and then the cost center, profit center, and then the segment. So now, using the segment, you can actually, segment is nothing very similar to the profit center. It could be one-on-one, or it could be one-to-many, segment to the profit center, and you can derive a profit center from a segment, and profit center is mandatory in the new GL. For both the balance sheet items, and basically you can get your balance sheet below the segment level. Previously it used to be company code level, now it's below the segment level. Now they added something called ledger, which is above company code, L0, L1, L2. Parallel accounting, I'm going to skip. Parallel accounting, skip. Okay, so postings ledger method. Postings made to a single account, single GL account, are updated in all ledgers based on the accounting principle. You can maintain multiple ledgers, and you can tie the accounting principle to each of the ledgers, like GAAP, IFRS. So L0 would be, if you're a US company, L0 would be GAAP. Your L1 ledger would be IFRS. So based on the accounting principle, it updates both the GAAP ledgers. It also updates your non-leading ledgers, which is your IFRS ledger, at the same time. It's called the ledger method. So ledger-specific postings are supported where accounting principle requires specific entries. If suppose, for example, IFRS requires that you value options differently, it posts your L0 and posts back to your L1 based on the accounting rules for IFRS, which could be different from GAAP. Leading ledgers and non-leading ledgers. There is exactly one leading ledger at all the times. Okay, activated the company code. Only the values for the leading ledgers are posted to the CO. Leading ledger gets any of its parameters from the company code. So one company code is tied to this leading ledger, and there are non-leading ledgers which are assigned to alternate currencies as well as the alternate parallel accounting structures. So there is a leading ledger. There is only one leading ledger. Actually, at the client level, there are non-leading ledgers which are assigned alternate currencies or different physical variants and differ from the leading ledgers. Okay, so this is actually an interview question. They'll ask you if you have a leading ledger, and if you're a company in Dubai and if they have a different physical year variants, how does it work? So you do that using non-leading ledgers. Okay. So parallel ledger options, you have fewer GL accounts. In the older version, people kept adding GL accounts based on IFRS accounts or GAAP accounts. So they just adding accounts for different accounting purposes. So new GL minimizes that. You only have fewer new GL accounts. Fiscal year variant, company codes with different fiscal year variants are assigned to a separate ledger. Very key concept. A lot of people ask this during the interviews. Company codes with different fiscal year variants are assigned separate ledgers. Okay? And posting period variants, postings to the ledger can be separately controlled by assigning a separate posting period variant to the ledger. So you can individually control, each ledger can have a different posting period variant as well as a fiscal year. And you're going to have fewer GL accounts because you have the leading, ledger versus non-leading ledger, concept. New GL is all about concepts. There is very little, there is configuration, but it's very little. It's very conceptually enriched. If you understand the concepts, there is very little, you have to do in terms of your configuration. Currency valuations. The automatic postings are updated to appropriate ledgers based on the relevant accounting principles. Again, we'll talk about the accounting principles, how they are assigned, different currency valuations and different accounting, principles. Okay. And then the main thing is the splitting. System automatically splits the accounting. Let's say you have a vendor line item. System automatically splits that based on profit center segment and the other custom customer fields. We'll look at that concept in a second. Online splitting of the invoices. Okay, so you have a vendor invoice here. You have two. You're payable to the vendor. Here is $1,000, and you're splitting that. Not splitting. Sorry. You have two balancing entries for these things. So each one, this is an expense account, okay. This is a debit, and this is a credit balance. And you have two different profit centers assigned to two different expense line items. But you only have one payable item, right? One payable line item. So these profit centers will not know at any given time what is the total payable obligation. So this is the old version, so you have to wait until at the month end close to be able to know. Once it's closed, to know what is exactly your AP balances by profit center level. Right now you do get balances at the company code level, but not at the profit center level. Okay, it's very key. Make sure you understand this one. So what the new GL does is it takes this payable line item and then splits it proportionally based on this profit center line items. You see PL profit center 1, profit center 2. This profit center 1 is for this expense account 51001, and this is another expense account 51002. Two different expense accounts, two different cost centers. So it's going to take that and split proportionally like this. Two different payable item. It's going to carry. It's going to carry means it's going to call in this called inheritance. It's going to take this profit center, inherit it. Take this profit center, inherit it. And then break this down into two different line items like this. Okay, and it's going to post to the totals table and also post this splitting information to split info table at the same time. Single document, but it's making multiple postings. So it's called the online split invoice. It's called the new GL split. So this is a very key concept. It also generates a lot of accounting entries because it's splitting a single line item into multiple line items by profit center and by cost center. So when you're looking at your balance sheet in real time, this profit center will show you its payable entries, how much payable is outstanding in real time, which you could not do that before. Okay, everybody got that?
Yeah.
Okay. Same thing here. You have one payable line item and you already paid, sorry, you already paid that item, and then the cash clearing account has been booked for $970, and then the vendor has given you two discounts, discount of $12 and $18. Okay, now the discounts are also broken down by your profit center proportionally. Okay, and also your bank payables are also broken down, proportionally. So now you also know that, hey, how much cash is outstanding by profit center. Now here you know that only company code has paid that cash, but now you know by profit center, by segment, profit center will derive the segment. So by segment you would know, what are the cash clearing entries, that were booked by profit center. The documents are getting enriched. Your clearing documents are getting enriched. So this is your invoicing document and this is your clearing document after things are being paid, right? So both instances, you're seeing the expense line items being split. You're also seeing the clearing entries also being split in proportionally in two different things. There are some issues here. So the thing to understand is that in the new GL you still have the BKPF and BSEG table. There are some new tables, additional tables called FAGL Flex A table and also FAGL SP Split Info table. So this is the key. It's called the Flag of Flex table. They will ask again in the interview what are the new GL tables. So you should be able to answer that. And a line item does not get split if the character is already filled in the. So there is a lot of substitution and validation going on in the new GL tables. So we'll look at that. What is the substitution, what is the validation in the new GL tables. All the known issues, OSS notes and things like that. Segments can be used to meet international accounting rules. So if a company has more than 20% of the business from any of the segment, they're required to maintain a balance sheet by that segment. For example, ExxonMobil, if their 20% of their business is coming from real estate sector, they're required to maintain a separate balance sheet for that. Even though they're an oil and gas company, if they're 20% of the business coming from real estate or medical devices or finance, they are required to maintain the books by the at the segment level. And the new GL allows you for that, okay, to maintain the books at the segment level. So it's not 20%, 10%, okay? If an asset of a operating segment exceeds 10% of the total assets, or revenue of an operating segment exceeds 10% total assets, you're supposed to maintain additional ledger. Maintain a full balance sheet. In the old segment, in the older version, again this is an interview question, how FI and CO are kept in sync? Can anybody answer that question in the old FI? Let me break this. So the key concept for GL is the scenarios. One is the cost center, business area, segment, cost of sales accounting, profit center update, and preparation for consolidation. So most people use the three: cost center, business area, or segment. This is called the scenarios for which you can define how the new GL is going to work. But you can also define your own scenarios. Okay, these are the custom defined scenarios for SAP. And asset accounting and parallel ledgers, you can consider the FI asset accounting to report on different accounting principles. For example, accounting principles require you to do valuation of your fixed assets depreciation determined differently, GAAP versus IFRS, because you're maintaining the leading ledgers, leading ledger and as well as the sub ledgers, and you need to maintain the depreciation area assigned to the leading ledger group. So there is a leading ledger and leading ledger group. If you assign the depreciation area to leading ledgers, so depending on the accounting principles, the system posted accounting, asset accounting or depreciation to the proper postings. Pavani, I know you worked on asset accounting. How did you do that before? How did you manage the GAAP versus IFRS before? Hello? Pavani,
Hello?
there?
Hello?
Yeah, how did
Hello?
you manage the,
Can you hear?
in asset accounting, how did you manage the GAAP versus IFRS before?
Like I worked only this state project, right? So in this, like I didn't do anything, like, but I just saw the reports which they have configured for the depreciation and all, but I didn't do anything regarding that one.
Okay. Yeah, typically what they do is they maintain separate GL accounts, separate GL accounts, for different depreciation principles. And your depreciation area is assigned to those GL accounts. That's fine. Okay, I'm gonna show you allocation for these operations between the split. Let's try to get to the scenarios first and then go back. We'll go back to that page.
Okay.
I already want to see the scenarios here. Okay, anyway, let's go back. So current functionality being used, focus on functionality being used in FI, CO, the key additional margin, special ledger, business area, PCA. Looked at that. So here what they're talking about is the approaches available for multi-gap valuation within SAP. Previously, we only used account-based, means we would create different GL accounts for different accounting principles. Easiest to implement, can lead to unmanageable set of accounts. Works both in the classic ledger and as well as the SAP ledger. And in the new GL, use the parallel ledger concept. Most transparent approach. You would not work in the classic GL. Only works for your SAP general ledger and independent of the set of the books and features the IFRS requirements, most easily accommodatable. So we are going from the account-based model to a parallel ledger model. Different approaches. So this is the account-based approach, how it works. Uses a single ledger, means just one set of chart of accounts. Could be leading ledger for the, that could be the leading ledger for SAP general ledger accounts. So basically accounts are grouped according to the legal requirements. So 3000 to 4000 would be operational chart of accounts, 5000 to 5000 will be IFRS, 6000 to 65 will be local GAAP. So if your accounting requirements only have GAAP impact, you would post the GAAP. They only have IFRS requirements, you would post the IFRS. You have a common set of GL accounts, pure GAAP accounts, and pure IFR accounts. So this will be replaced by one set of common GL accounts, and you have a leading ledger and the non-leading ledger. which is going to be which will support both the leading ledger supports the gap and non-leading ledger supports your IFRS. So you're going from this version to a different version. Okay. So consideration approach is the leading ledger L1, which will be your local gap standards, and you created a non-leading ledger, which would be for IFRS and other accounting principles. We'll skip that, skip that, skip that. Well, this approach we looked at, skip that. Yep. And how does it work? If you're moving from old GL to the new GL, usually there is something called a migration cockpit that SAP gives you. Only some authorized people are allowed to use the migration cockpit. Basically what it does, it migrates the balances from your old classic GL to the new GL format. In the new GL, the totals table, in the old GL, the totals table is GLT0. In the new one, it's a flag of flex A table. It basically migrates your balances from GLT0 to flag of flex A or T table. Okay? So kind of moving away from, so GLT0 will no longer be used going forward. If you're looking for reporting your balances. Basically balances, migrates the balances from your old GL to the new GL table. It checks to make sure new GL is activated, looks at the balances in the old GL table, and then balances takes all the balances by company code level one at a time and migrates it to flag of flex A table. Okay, this is how your cockpit looks like. So it's a general migration cockpit, goes through checks at each time. You just go through one step at a time, and it migrates your complete balances from one ledger to the other ledger. It migrates all your open item balances. It migrates your current year documents will be transferred, and it also carries your balance carry forward, and it also makes some balance adjustment. There are 4 different categories it does that. It looks at all the open items, looks at all your current year documents, anything that you posted in that particular year, and then moves over to 2014 back to 2015 and makes balancing adjustments. And transports relevant OSS node, new GL security, and checks for data consistency. Stop it here.